Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. It's the 26th of January 2024 and here are the questions we'll be answering today. Has Zee run out of options after merger collapse? Are Indian businesses ready for a cookieless market? What do retail investors want from interim budget? And what is stress testing in finance? Till a few days ago, they were busy in hectic parleys to form a formidable $10 billion media empire in India. And now, broadcasters Zee and Sony are fighting a pitched battle in courts. While the court proceedings will follow its own course, how will the collapse of this proposed merger affect Zee, whose revenue and profit growth have been muted over the past 2 years? Has Zee run out of options? Abhijit Kumar has the answer.
The stock of Zee Entertainment Enterprises is currently in a free fall. Since the announcement of the termination of the $10 billion merger with Sony, the company's fortunes have plummeted. Zee has reported flat performance in the past 4 years as revenue growth has converged flat in FY 2022-23 and EBITDA margin dipped to 10.7% in FY 24. Reason for the tapered revenue growth has been attributed to losses in the OTT and TV businesses. And now, the country's leading media conglomerate is caught at a crossroad of financial challenges and collapse of a mega merger plan. The Zee-Sony merger negotiations collapsed because the two entities could not agree on who would lead the new company. And at the center of it all was Zee's MD and CEO, Puneet Goenka. In June 2023, market regulator SEBI barred Zee Group patriarch Subhash Chandra and Puneet Goenka from holding any key positions in any listed company amid fund diversion allegations. Later, they got a relief from the Securities Appellate Tribunal. The ban was overturned and Goenka was allowed to retain directorships in Zee Group. Grappling with financial challenges, Zee hoped that the merger would strengthen its market position. Meanwhile, Sony aimed to expand its presence in the Indian media landscape. So, can Zee survive this mounting crisis?
I think they can surely survive in the M&E industry. There is no doubt about it. But two things is that, from a growth standpoint, from a market share gain standpoint, there are going to be challenges because what this deal of Zee-Sony would have brought on the table is, multiple synergies between both these entities, a lot of technological advantage because of Sony being an MNC company, and they could have, scaled up the market and, probably grown faster than the market and gained market share as well. So I think that seems to be an uphill task now because even the external dynamics are changing. Competitive intensity has probably will go up because of RIL Disney, being in talks. So growth, is going to be quite subdued and a challenge. But yeah, survival is definitely something which I don't see an issue with. Secondly, even the valuations somewhere, will remain subdued because whatever valuation uptake that the stock had seen was primarily, because of the merger and primarily because of, Sony coming in and the business synergies and the potential market share gain that would have happened. So I think even the valuations will see a sharp de-rating, and we've already seen the stock is down more than 25%. And I think there's no trigger or respite for valuations also to move up. So there's a concern on internals in terms of business and valuations for Zee.
Among leading media firms by revenue, Google India and Meta took the top spots in FY23. Zee was placed 4th and Sony at 6th. Analysts believe if Sony, Zee, Disney or any other media conglomerate has to take on the tech giants that dominate the Indian media sector, scale is critical. Following the Zee-Sony deal failure, the upcoming Reliance-Disney merger is seen as a potential winner, despite taking a valuation hit. The Reliance-Disney alliance stands to gain significant ground in the Indian TV industry with unmatched resources and rich content offerings. With nearly 32% of TV viewership, the Reliance-Disney merger is slated to monopolize the Indian media industry. Hopes were pinned on the Sony-Zee merger to keep the landscape duopolistic. But the failure has now positioned Reliance Disney as a dominant force in the Indian media scene. So how will Zee fare against a merged RIL Disney media behemoth?
So with the merger between Zee and Sony off, I think it's advantage RIL In any case, RIL has the has the IPL rights, and that's a big advantage, because the online streaming game is basically about two things. One is about live, and live sports in particular, because then a large number of people congregate together to watch something, and that's advertising driven. And the other is the catalog game, where the volume of content that you have available caters to a wide variety of users. Because what the internet has done is it's unbundled content. So therefore, it's extremely difficult for someone that has been used to playing a linear TV game to adapt to online, because it's all about piecemeal content, about binge watching, and that's where Zee's also struggled, to be honest. So I think Zee is going to struggle to compete with the likes of RIL and Disney if they do merge, or even if they don't merge. And Sony's been struggling as well. So while this merger would have made sense from a linear TV perspective, I don't think it really works even from an online perspective, because they don't have that much catalog content.
While both have robust film divisions and OTT platforms, Zee has a better position in broadcast business and Sony excels in the digital space. At 12 million paid subscribers, Sony Live is the fourth largest paying streaming service after Hotstar, JioCinema and Amazon Prime. After the failed merger, Zee and Sony will now struggle to get firm hold in their respective weaker segments. So can Zee find other partners to stage a revival?
Of course, it can find other partners, but it would have made more sense if it had a partner, from the M&E ecosystem. Because currently, as we speak, there are very few players in the M&E ecosystem who would actually have a very big interest in the linear TV side. And Disney already in talks with RIL, and Sony out of the question. We don't feel that there are any kind of takers for Zee as such, and we don't even foresee any kind of other global giants coming in. So they could have probably some financial or strategic partner who could come in, but that financial or strategic partner wouldn't get the business synergies what a Sony would get. So from valuation standpoint, even if there is somebody, valuations will not go back to where they were because of the Zee-Sony merger getting called off.
The collapse of the Zee-Sony merger marks a pivotal moment for the Indian media and entertainment sector. As Zee looks for alternative strategies and Sony reassesses its India-focused plans, the stage is set for further transformations within the industry.
The Reliance-Disney merger, on the other hand, is on track. Both the companies have recently appointed law firms and started antitrust due diligence of their planned merger. Moving on, the world's most popular browser, Google Chrome, will soon be phasing out a very essential tool that brands swear by for tracking users. We're talking about third-party cookies. Now, while this is good news for user privacy, businesses may not be equally happy. They are apprehensive. So are businesses in India prepared for a cookieless market? Kasturi Akhil finds out.
Google Chrome users will no longer have to deal with accepting third-party cookies before accessing any website. Google is set to scrap third-party cookies from the popular browser, much to the advertisers' disappointment. Cookies are special files that allow websites and advertisers to identify individual web surfers and track their browsing habits. However, this will not happen overnight. Google will be phasing out the cookies through the course of 2024. Third-party cookies will be turned off for 1% of Chrome users, or reportedly some 30 million people in the first quarter of 2024. And gradually, Google will ramp up restrictions to 100% of users by the third quarter. This follows several delays, mainly because Google sought to provide marketers with additional time to adapt their advertising strategies and explore new, less intrusive technologies for targeted advertising. The move will not just affect digital marketing and advertising, online businesses will change too. Vinay Damboli of LS Digital told Business Standard earlier that businesses that heavily rely on targeted advertising, especially those using programmatic advertising and retargeting strategies, may face challenges. But what will be the ramifications? Nikhil Pava of Medianama elaborates.
In a sense, because the Indian market is driven significantly uh, 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 by performance advertising, by delivering results, actually leading to either clicks or sales. I think all of this is going to eventually get impacted, and the other impact on agencies and platforms is going to be how do you attribute a sale. So sometimes what happens is in performance advertising that a user's tracked for a period of time, and let's say they may visit a product now, but because they've been seeing that ad over 3 or 4 or 10, 15 times, they might close that sale 3 days later. And so the platforms still that where those ads have appeared, they also get paid for that ad in a sense, or for that closure of sale. And some of this measurement is going to become very difficult because you won't be able to track people over a period of time.
India's digital ad spends, according to a report by IPG Media Brands, accounted for 46% of the entire ad market share in 2023. As per the report's projections, India's ad revenue in the digital format stood at 49,833 crore rupees and is projected to rise nearly 14% to reach 56,900 crore rupees this year. With no access to precise details about the who, what, and whereabouts of the consumers, industry observers believe maintaining return on investments on digital ad spends would be substantially impacted. Indian startups that rely on targeted advertising may face challenges in adapting to a new advertising landscape while grappling for additional marketing funds. However, Siddharth Devnani of Socheers, a digital ad agency, believes the impact on startups may be limited.
When it comes to the question of, D2C brands or startups, most of them are not relying too much on this today already. Not to say that they're not investing in these kind of advertisements. I'm not expecting a lot of them to be heavily dependent on their day-to-day revenues from these sources. Right? Because if you could, look at any D2C startup which you are buying stuff from, is very, very likely you discovered it either through social media or discovered it through an influencer or discovered through maybe a Google search ad. And none of these are likely to have any impact because of this, right? What's going to be impacted is display advertising, which forms a smaller part of revenues and impact of it for, the D2C brands and the startups.
Marketers will have to collect first-party and second-party data, which marketing experts argue requires a lot of investment and upgradation of technology. First-party cookies are directly stored by the website one visits, and the website owner can choose to share the cookie data with a trusted partner, classifying it as second-party cookies. Google has said it will ensure that advertisers, marketers, and businesses are not left in the lurch. It has created a privacy sandbox, which is a collection of technologies that aims to create web standards in advertising without compromising user privacy. As told to Business Standard by LS Digital's Vinay Tamboli, AI-powered algorithms will also help in understanding consumer behavior patterns and preferences without breaching user privacy. Experts believe that Indian businesses are now better placed when it comes to coping with new advertisement strategies. Moreover, with Google adopting a gradual approach towards phasing out third-party cookies, the advertising and marketing industry have sufficient time to equip themselves with appropriate tools and technology to adapt, thereby minimizing the impact on the ecosystem.
But for now, businesses are more keen on seeing what is in the store for them in the upcoming interim budget. It will be tabled on February the 1st. The current budgeting exercise is confronted by economic headwinds such as the deceleration in the global economy and strains on the rural economy. Against this backdrop, Nikita Vashish brings us a report on what markets are expecting from this interim budget.
Union Finance Minister Nirmala Sitharaman will table interim budget on 1st February, but a full-fledged annual budget for fiscal year 2024-25 will be presented in July once a new government is formed post-general elections. Investors therefore expect the Finance Minister to use a vote of account on 1st February as an opportunity to underscore its economic accomplishments in the lead-up to the elections. The budget in July, they believe, may offer a roadmap of fiscal policy in the post-election period.
The government's priority would be fiscal consolidation to reach a 4.5% fiscal deficit target by financial year 26. That is the fiscal glide path. And that also is desirable from investors' perspective because fiscal consolidation is good for the macroeconomy as well as the stock market.
However, any fiscal consolidation at the cost of capex may not be liked by the markets, cautioned analysts at Jefferies. That apart, changes in tax policies would also be tracked by investors.
There is a double taxation of corporate profits. There is corporate tax on corporate profits. And when part of the corporate profits are distributed as a dividend, this dividend becomes taxable in the hands of the taxpayer, the dividend receiver. That said, we don't expect this abolition of double taxation in this year's budget, interim budget.
Removal of securities transaction tax, reform in long-term capital gains tax, reform in tax treatment between equity mutual funds and unit-linked insurance plan, and a comprehensive policy on cryptocurrency regulation will also be on investors' radar. As regards bond markets, Pankaj Pathak of Quantum AMC said, investors are eyeing borrowing numbers for FY25, where gross borrowings are pegged at Rs 14.8 trillion and net borrowings at Rs 11.2 trillion. Overall, market expectations remain subdued from the interim budget as investors expect focus on the upliftment of the bottom of the pyramid. Populist measures, therefore, cannot be ruled out. Equity markets are shut today on account of Republic Day.
He's making plans for an early retirement. Business Standard.
Markets regulator SEBI, meanwhile, is busy strengthening guardrails. It is planning to comprehensively stress test equity mutual fund schemes and come out with measures to handle potentially dangerous situations. But what is stress testing? Ayush Mishra explains.
Markets are overvalued, and investors are putting a significant amount of money in riskier equities. This has the Securities and Exchange Board of India worried. As such, the market regulator is considering a comprehensive stress test for equity mutual fund schemes. The exercise aims to evaluate the impact of plausible adverse scenarios on the resilience of mutual funds in India. In the calendar year 2023, 40% of the total net inflows into active equity schemes were directed towards small cap and mid cap funds, receiving 64,000 crore rupees out of the total inflow of 1.6 trillion rupees. In the near term, investment in small and mid cap funds may result in short-term losses as they are extremely sensitive to market sentiments. Since mutual funds have to pay back investors within a couple of days of redemption notice, risks on the liquidity side can become a challenge, especially during periods of distress. With stress tests, mutual funds can evaluate if they'll be able to meet large redemption pressures. Financial institutions like banks and insurance companies employ stress tests as a part of their risk management strategy for assessing the resilience of investment portfolios or specific financial instruments. The goal is to analyze how well a financial entity or product can withstand economic downturns or other unfavorable scenarios. The tests simulate extra events that may be unlikely but could have severe consequences if they were to occur. These scenarios could include market crashes, economic recessions, interest rate spikes, currency fluctuations, or other financial shocks. Such stress scenarios allow analysts and risk managers to assess the vulnerabilities in the system and develop strategies to mitigate potential losses. Stress testing is a crucial component of the broader risk management framework in the financial industry. As a part of the risk management framework, SEBI mandates all asset management companies to conduct stress tests on all liquid funds and money market mutual fund schemes. In the event of a stress test revealing any vulnerability or early warning signal, AMCs are required to bring it to the notice of the trustees and take corrective action as deemed necessary.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Several asset management companies have also taken steps to safeguard against any eventuality. For example, they are not taking lump sum investments in small cap and mid cap funds. Well, that's all for today. For more news, views, and insights, please log into business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.